Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Alicon Castalloy Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, sir.
Thank you, Margaret. Good day, everyone, and thank you for joining us on Alicon Castalloy Limited's Q3 FY22 earnings conference call. We have with us on the call today Mr. Rajeev Sikand, Group CEO, Mr. Vimal Gupta, Group CFO, Mr. Shekhar Dravid, Chief Operating Officer of Alicon Castalloy Limited, Mr. Andreas Heim, Managing Director of Alicon Castalloy, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castalloy Limited. Mr. Vimal Gupta will cover the financial performance for the quarter, following which Mr. Dravid will walk us through the operating highlights. In order to share a more granular view of the initiatives towards both the global and domestic markets, we also have Mr. Andreas Heim and Mr. Rajiv Gupta to provide insights on these areas, following which our Group CEO, Mr. Rajeev Sikand, will give us a brief summary of the quarter gone by. Thereafter, we shall open the forum for a Q&A session. Before we begin, I would like to point out some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with all of you earlier. I would now like to hand over the floor to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good morning to all our investors. I hope that all of you and your near and dear ones are safe and well. Thank you for taking the time out to join our earnings call. We have reported a steady performance in the third quarter and delivered continued improvement each quarter through the year-to-date period this fiscal. This quarter witnessed several macro challenges coming together and intensifying. Alicon faced and combated 4 such key challenges, which we have termed as 4 C's. The first C is Corona, being the impact on our operations on account of the third wave of the COVID-19 pandemic, which impacted overseas operations from mid-September and resulted in muted demand in domestic markets, especially in the later half of December. The second C is semiconductor, as the chip shortages and supply chain constraints, which persisted during the period, impacting volumes for the automotive industry across the globe, especially in high-end vehicles and high-value addition parts. This in turn moderated our sales performance during the quarter. The third C was the cost-based inflation, wherein we saw higher input material costs on account of the inflationary trends and even increased freight and logistic costs led by supply chain issues. And the fourth C was the cost of new product development. However, with rapid change underway due to EV evolution and lightweighting, which has come with only a short gap from the switch from BS4 to BS6, the product life cycles are shortened. Overall, the quarter was marked by these 4 key challenges, and despite the non-linearity, we delivered steady top line in the quarter, with consolidated revenues from operations at rupees 278.9 crores, higher by 4.2% over the immediately preceding quarter. The 4 C's impacted profitability too, especially the continuous increase in commodity prices along with inflated freight costs and cost towards new product development, which resulted in higher expenses during the quarter. However, our sustained cost reduction initiatives using Kaizen principles enabled cost reduction at micro level across our operations. This was supported by a slightly enriched product mix, as we were able to increase the volume of higher margin products. Like we had indicated last quarter, we have been working collaboratively with our customers to undertake price corrections and have successfully passed on some part of increased costs. The combination of these above factors have helped us to support margin performance. has been yielding results, with our margins coming in stable at 12.1% in quarter 3. Another aspect to keep in mind is that the alloy prices are passed through for us, but higher prices elevate the denominator. So even when absolute EBITDA remains intact, the EBITDA margins will naturally reduce due to higher denominator. In quarter 3, the effect of higher denominator has led to EBITDA margin reducing by over 1%, and had alloy prices been stable, we would have reported an EBITDA margin in excess of 13% this quarter. While the margins were lower by 40 bps year-on-year, on a quarter-on-quarter basis, they are higher by 268 bps compared to quarter 3 last year. So overall, the impact of our margins has been largely contained despite the combination of challenges we faced this quarter. Another highlight to note here is that all our operating costs are tightly controlled and optimized across our business model. Even when the operating environment normalizes, we do not anticipate significant increase in the cost model going forward. Overall, the gross margin stood at 50.1% in quarter 3 FY22. Our EBITDA stood at 33.8 crore. Profit after tax during the quarter stood at 12.1 crore. With our continuous focus, as cost pressure stabilizes, we expect our EBITDA margins to return to pre-COVID level of 14 to 15%. On the operational front, in quarter 3, our factories in India and Europe did not face any mandated lockdowns despite the disruptions due to the third wave. We continue to do our best to ensure we create and maintain a safe workplace for our people. Despite the cost pressures and supply chain disruption, we have focused on ongoing improvements. We witnessed a sharp increase in alloy prices, which had a resultant impact on cost of inventory and on debtors. However, we were able to drive greater efficiencies, which had enabled us to actually improve the working capital days despite these pressures. We expect this to stabilize going forward. During the quarter, we have reported steady cash flow from operations. The conclusion of equity raised through QIP and preferential issue has further helped enhance our liquidity and balance sheet position. On the balance sheet front, our net debt has been maintained around 200 to 50 crores, and the net debt to equity ratio remains comfortable at 0.55. As you would recollect, last quarter we had discussed that we have deferred our capex for financial 22 due to the uncertain macro environment led by COVID-19 disruptions. So we had envisaged rupees 90 crore at the start of the fiscal 22, but we mostly would be closing this fiscal year around 55 to 60 crores. More importantly, this capex has been utilized towards upgrading capabilities and elevating end of process capabilities, such as finishing and machining. Thus, we have leveraged our unutilized capacity at the back end and deployed capital towards value addition in the front end of the process, enabling us to deliver greater value creation for customers, enabling margin addition. The balance of rupees 30 to 35 crores, which is deferred capex for the FY22, along with fresh capex to the tune of 60 crores, will be invested towards growth in FY23, resulting in cumulative capex of 90 crores next year. We anticipate a normalized operating environment in FY23 and expect faster recovery. To summarize, we have reported a resilient performance during the quarter despite the disruptions in the automobile industry. We continue to operate a healthy financial profile and strong balance sheet. In a normalized environment, we look forward to building on this further. On that note, I would like now to hand over it to Mr. Shekhar Dravid, who will talk about operating highlights for the quarter.
Thank you, Vimal. Greetings to all. I trust all of you are well and staying safe. The trends in the domestic auto industry continued to be a mixed bag. While we saw strong demand and higher consumption in the markets led by festive and holiday seasons, inflationary trends in the global markets and a touch of a third wave during the later part of December impacted sales performance for the industry as a whole. The auto and auto ancillary space continued to witness bottlenecks in the raw material supply chain. As a result, during the quarter, the industry has experienced an extremely challenging and volatile input price environment. In some cases, we have seen aluminum and related alloys breach new highs. The new wave of a pandemic in certain Asian countries has resulted in aluminum prices reaching a fresh 14-year high. In addition, logistical problems and inflation in shipping and freight costs further downplayed the momentum in sales. Across the domestic industry, CV volumes saw improvements during the period, supported by the healthy demand for both passenger and cargo segments. Two-wheeler volumes, however, saw a notable impact due to lower consumer sentiment affected by the third wave of the pandemic. Similarly, the PV industry sales continue to be impacted by the supply chain constraints and the semiconductor shortages. Besides weak rural sentiment, delayed harvest season, floods in the southern states as well as higher fuel costs restricted the pace of recovery in the quarter. On the international front, most of our key export geographies in US and Europe reported strong auto sales led by festive and holiday demand and stable currency. So against this backdrop, we have reported a stable performance during the quarter. The 4C framework that was discussed by Vimal impacted our overall growth in the quarter. This is one of the rare times wherein we have seen all these operating challenges acting together in the industry. However, it is noteworthy how our team has been able to navigate through this difficult situation well, and we have been able to seamlessly manage supplies to all our customers on time. In the quarter, we have added 30 parts from 9 customers. Let me talk about the highlights of our performance across each of our 5 key strategic growth pillars. The first being our auto business. This industry in the past 2 years has been adversely impacted due to COVID, mobility restrictions across geographies, supply chain issues, and raw material inflation. However, as an environment is normalizing, we are seeing the mobility sector on a whole bouncing back with a staggered recovery in sales. The consumption across vehicle segments, be it passenger vehicle, commercial vehicle, or even the two-wheeler segment, is on the increasing trend. So what we are seeing is that while supply chain issues moderated production across the industry, the end consumer demand has been on the uptrend. There are telltale signs that suggest semiconductor supply shortages could begin to ease in the later half of 2022, albeit in the phased manner. This will further boost sales in the industry. Another data point here is that if you were to look at the penetration levels of the cars across the globe, India is one of the lowest, with around 225 registered vehicles for every 1,000 people. Encouragingly, there has been a constant increase in this number in the past decade, and as the microenvironmental recovers, the car consumption and the penetration levels will keep growing. The pandemic, for instance, has accelerated the consumption for consumers preferring personal transportation modes. We have been seeing sharp rise in first-time auto buyers across urban, semi-urban, and rural markets, with improving traction in vehicle registrations. So overall, the outlook for this segment remains solid, and this in turn bodes well for Alicon. The global industry witnessed a downfall of 13% in last quarter over last year, quarter 3. Alicon witnessed a growth of 22%. New order wins SOP helped to perform predominantly better than the market. In IC segment, we are seeing strong inquiry levels across domestic and export markets. We are also seeing repeat order wins coming in from customers such as Eaton, Garrett, and Maruti Suzuki. I am happy to share that in the quarter, we have won orders for 7 new parts from these customers. Coming now to the second of our growth pillars, which is the electric vehicle division. The division continues to register exponential growth, not just in India, but also on the global level. According to the reports by the International Energy Agencies, roughly 130,000 EVs were sold every week in 2021, as against 130,000 EVs sold worldwide in the year 2012, suggesting an explosive growth. In the year 2021, while we saw the auto industry reporting moderate growth across traditional and hybrid segments, EV sales marked a healthy growth. Closer home, the total registered electric vehicle sales in India more than doubled in 2021 as compared to 2020 and crossed the 3 lakh mark in 2021, the highest ever annual volumes. December, in fact, was the first time when electric vehicle registration crossed the mark of 50,000 in a month. 90% of the sales in India were in two-wheeler and three-wheeler segment. The market has seen strong proliferation of exciting EV models by established and new players. This, along with increased preference for personal mobility, reducing price parity between EVs and the IC vehicles, and growing awareness about the global warming continues to fuel growth in the EV sector in India. In the Union budget as well, the government has announced supportive policy for electric vehicles. The announcement of a new battery swapping policy will improve the country's EV infrastructure and create an impetus on faster adoption of environment-friendly public transportation and three-wheelers. Auto manufacturers will also be encouraged to develop sustainable processes for batteries, which will help in increasing the EV ecosystem efficiency. For this segment, we are working with OEMs as well as the Tier 1 suppliers. We have been working extensively with Dana Corporation, Scania, Tata AutoComp, Arrival, Eaton on both domestic and international orders. During this quarter, we have won orders from existing customers such as Tata AutoComp and Scania. We have also had a new logo win in this quarter. We have received an order win from a customer called Arrival for 17 new parts. We are the first Indian supplier to be empaneled with Arrival, which manufactures electric buses and vans and belongs to a niche segment. They currently have the plants in UK and USA and are coming up with the plants in Spain and India. In addition to the 17 parts already booked, we are in close discussions for other opportunities related to our frugal engineering and thermal solutions. We introduced lightweighting solutions, high pressure die casting to low pressure die casting conversion by giving customer advantage of a lower capex, thermal solutions for the components like battery housings and motor housings and other such technological advancements. One such area where we are seeing strong response from customers in the lightweighting of the products in the auto and EV space. We are getting increased inquiries from the OEMs both in domestic and export markets and the development of various product categories such as motor housing, battery housing and controller housing. In December 2021, for the first time ever, Tata Motor was the second highest seller of vehicles in the passenger vehicle segment. JLR, a Tata Group company, has already announced 100% EV by 2025. We are already supplying EV parts from our European subsidiary to them, and now we are in active discussions for the opportunities from India. Another exciting development for us has been the breakthrough order wins with Tata Motors. We have been observing the progress being made by Tata Motors, which has emerged as a leader in electric four-wheeler as well as passenger vehicle category in India, and we are very keen to be empaneled as a supplier given the prospects for the strong volumes. We are delighted to share that we have been empaneled for 2 critical and complex motor housing with them in the last quarter with a good volumes. With the industry on the cusp of next phase of a growth, Alicon is one of the front runners in the EV space to capitalize on these growth prospects. We have already built up a portfolio of over 101 parts catering to EV, and other revenues from EV business stands at 9% in quarter 3 financial year 22. Our target is to bring the wallet share of EV business to 36% of our overall revenues by financial year 2025-26. Clearly, we are progressing well with our strategy, as 57% of our new orders during the quarter were from EV segment. Now on to our third growth pillar, being a technology agnostic platform. This segment is where we are directing a focus, bringing value addition to all our product categories. Alicon's philosophy has always been towards manufacturing innovative and differentiated products. Having a European hub at an early stage of our growth journey gave us a first mover advantage in the domestic markets. During the quarter, we have received orders from KTM. Coming to our fourth growth pillar, which is a non-auto business. In this, we are witnessing healthy growth in demand, especially from the defense sector. During the quarter, we have received an order win from existing customers like JCB and a new win from Textron USA. In the non-auto business, we have been seeking to add critical and complex parts in this segment with sustainable volumes. With the empanelment with the Textron USA for fully machined cylinder supply to the US market, we will be able to showcase our capability of manufacturing such parts to the other OEMs, which will open up more opportunities going ahead. Our previously announced orders are progressively as per the schedule, and we expect strong order wins in the quarters ahead. As discussed last quarter, we have submitted a tender of 4,000 wheels for defense, and we are expecting the finalization of the same shortly. We are penetrating with the existing customers like Siemens, GE, and Ingersoll Rand in this segment. The fifth growth pillar is our focus on improving customer wallet share and the customer stickiness. With several parts moving towards SOB, we are well placed to enhance contribution from repeat customers and demonstrate customer stickiness and belief in our brand. Our long-term approach is towards building wallet share and positioning ourselves as a trusted supplier for an existing customer base. On that note, I would like now to hand it over to Mr. Andreas Hem to throw light on our global business.
Thank you, Mr. Rabe. A warm welcome to all of you. I will briefly cover the development on our international business. We have delivered a steady performance in Illichmann during the quarter on the back of improving demand environment in our key global markets of US, Europe, and China. However, the chip shortage issue across the globe resulted in a significant impact on our international vehicle sales in the third quarter. For the quarter, exports, including overseas revenues, contributed to 22% of the total revenue, and for 9 months, it's 24%. I'm happy to share our exports, including sales from Illichmann subsidiary, stood strong during the quarter and was higher even on a sequential basis. We are also seeing increasing costs on account of inflationary trends in aluminum and other alloys. In addition, further freight costs have further resulted in higher expenses during the period. While this affected margin during the quarter, we have been pressing over the price hike, which was resulted in the steady profitability on absolute basis. Overall, we have delivered an enduring performance during the quarter and 9 months. While there are ongoing concerns about the pandemic in some of the key global markets, we have expected minimal and short-term impact. Overall, we remain very excited about our future growth prospects and opportunities in the medium to longer term across markets of Europe, US, Middle East, and Brazil. On this note, I would like to hand over to Mr. Rajiv Gupta, who will talk development in domestic business for the quarter.
Thank you, Andreas. Good day, everyone. We have seen mixed trends in the domestic auto segment during the quarter. While the demand has been upheld, issues on account of persistent raw material pressures and shortages have significantly impacted production levels for automotive players in the domestic industry. Lower production levels due to chip shortages have resulted in unusual waiting period ranging from 6 to 9 months. We're also seeing a dip in inventory levels across dealerships. Passenger car sales are seeing a continuous decline on account of chip shortage. Even entry-level segment is facing challenge due to increasing fuel prices and weak rural sentiment. The sentiment was further weakened by Omicron-related concerns in December and January. However, we are seeing steady recovery from mid-January onwards as concerns around the third wave have eased. Also, the chip shortage situation is easing out slowly and gradually, which we believe will elevate sentiment in the industry. Now, coming to the performance given the macroeconomic backdrop, Alicon was able to report steady sales in Q3 FY22. We have booked an average yearly sale of around 40 crore with project sale of around 155 crore over a period of 5 years in quarter 3. In 9 months cumulative this year, we have added 60 parts, of which 32 were in the EV segment with an average yearly sale around 330 crore with a project sale of around 130 crore over a period of 5 years. Our total order booking now stands at around 3,250 crore over a period of 5 years with a yearly average sale of around 650 crores till now. Overall, we are witnessing a good level of inquiries and bookings in the market and are hopeful that improving macros will further support this momentum. On this note, I would request our Group CEO, Mr. Rajiv Sikand, to share with you in perspective on Alicon performance.
Thank you. I welcome all our investors. Thank you for joining the call. I hope you and your family members are well and safe. I would like to add that the way Alicon team has overcome the challenges thrown at us in the last 2 years gives me every reason to be optimistic that we will negotiate further challenges that will be thrown at us in the ever-changing and dynamic scenario the automotive sector is facing. My confidence in the long-term potential for Alicon and the opportunities across the auto, non-auto and e-mobility space remains unshaken. While we are seeing headwinds in light of persistent raw material challenges, the chip shortages across the globe, there are signs of the situation easing out with the resumption of chip manufacturing across Asia, but my view is it will take another 2 quarters for it to really stabilize. We are hopeful that with the parts of the world moving away from lockdowns to learning to live with the virus, we should see the pre-pandemic sense of normalcy return soon across domestic and global markets. Educational institutions, corporate and private offices are now slowly opening throughout India. This, along with the augmented consumer sentiments, improvement in finance availability, and gradual pickup in economic activities will translate to a higher demand, especially towards personal mobility. In addition, better macros will further support in commercial vehicles in the longer term. As discussed by my colleagues, in the 9-month period, we have announced significant order wins with multiple OEMs. Our current order book stands at rupees 3,250 crores and this provides us with strong growth visibility for years to come. Our business fundamentals are strong, and we are proactively engaging with the existing and new customer groups to accelerate this growth further. We are focusing towards improving our product portfolio and have added a range of high potential SKUs across auto, non-auto and EV segments to bring in differentiation and value addition in our model. Sustainability is one of the cornerstones of our business framework, and we are pursuing many initiatives by way of business processes, manufacturing capabilities, and product development. Looking ahead, we believe that demand conditions in the market will continue to improve, and we are optimistic on the medium-term outlook of the auto industry. Also, Alicon's diverse product suite will enable us to capitalize on demand reversal. The recently announced Union Budget also announced growth-boosting reforms, which will further create and maintain demand in the market. The battery swapping policy, scrappage policy, PLI linked scheme, FAME scheme, and improved CAPEX towards road infrastructure augur well for the sector and will help boost consumption. On the whole, we look forward to a promising future. On this note, we would be happy to take your questions now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Saurabh Jain from Sushil Finance. Please go ahead.
Hello. Good afternoon, everyone. Am I audible?
Yes, sir, you are audible.
Yeah. Okay. So, first of all, congratulations on yet another wonderful set of numbers. And thank you for the opportunity. I have a few questions. My first one is, in your opening remarks, you mentioned about new logos added and some order wins from Arrival, probably for 17 new products you mentioned, and some products for Textron as well. So, would be helpful if you could quantify the orders and their execution timeline. Some highlight on that, and also the orders on hand was 3,650 crores plus. So, what would be the execution timeline for the same?
Okay. Over to Rajiv.
Yes, we have mentioned we have added 2 new logos in last quarter. One was with Arrival, and in the EV space, we have added 17 parts, and these are very critical structural parts for this bus. And the good thing with Arrival is they concept with setting up plants across regions. So as currently this opportunity is for the UK market, but there are chances of multiplying this opportunity once they come up with future plans in Spain and India. So if you talk about order opportunity, this order, the yearly average sale is around 10 crore for these 17 parts, and on a project basis, this will be around 40 crore in total. So this was a great achievement because Alicon was the first supplier from India who is awarded with Arrival. Second is Textron. Yes, we were eyeing in this particular segment because this belongs to a niche segment, and also these are very critical parts which give us it helps us to showcase our existing OEMs also. So this order is for the US market for a very critical complex cylinder head, and this also we backed in last quarter. And also we added is Tata Autocom with motor housing. We were eyeing this segment as mentioned in the last quarter because we noticed the Tata Motors in the domestic market were picking up quite well. And with that, we have added two critical parts. So with that scenario, in last quarter, we have confirmed yearly average sale of roughly around 40 crores with a total project value of around 150 crores over a span of 5 years. With this, my order booking now have touched to on a yearly average of 650 plus crores and total to 3,250 crores. The good thing over here is we're focusing on EV, and in last quarter also the total the order booking 57% comes from the EV segment. So that was a good sign what we have noted. And if you talk about 9 months, the EV contribution is 33%. So we are moving ahead with what we have planned or what we have strategized. Thank you.
Okay. So one follow-up on that. Of this 3,250 crores worth of order book, how much would be from EV overall?
17% is from the EV of total this 3,250 crores what we are talking. At this moment, it's 17%.
And this is also executable over the 5 years, right?
Yes.
Okay. So coming to my next question, it's amazing to see gross margins being maintained, especially during these tough times, which is currently prevailing across the industries, and this showcase our strength. Despite lower margins on the standalone, with substantial improvement in our European subsidiary, we have managed to maintain our overall profitability on a year-over-year basis. So the subsidiary continues to do exceptionally well with almost, I guess, 21% EBITDA margins. So how is the trend looking forward? I'm talking about a European subsidiary.
So sort of for that in the European subsidiary, the major margins now coming up from the EV segment because the orders are increasing, the volumes are increasing there, and we have negotiated because this is the initial stage and the development stage in the EV segment. So these margins now, this is the start, and when the volumes will grow. So hopefully we will be able to maintain because we can see that in the quarter 4 also, we will be able to even perform much better if we compare with the quarter 3. That are our expectations for this, and hopefully we will be able to maintain the same momentum in the coming year.
Okay. Sir, one follow-up on that too. This quarter we did a turnover of around 28 crores in the European subsidiary. How is the possibility of scalability here of the top line?
So for this, approximately this year we will be able to do 125 crores. But as per our strategy, we have not planned to scale it up to a large level. The reason being, we want to have, it is our development center. We want to use that location to develop our critical parts as a knowledge and also a knowledge center. Because whatever the developments we are doing in India, so those are being supported by the European team. Because you know that the cost of production in Europe is so high. Maybe you are seeing the margins are high in Europe. Maybe on that basis you are feeling that we should grow more there. But at the end, when the volumes goes up, so they also they also look for some alternate sources from low-cost countries. So our concept is that we will maintain maybe 120 to maybe maximum go to 200 crores in the coming 3-4 years. But the idea is to win the orders, bring the volume to India. So that is on that strategy we are working.
Okay, got it. And sir, my last question, what was the contribution from new orders during the quarter? And if I believe in previous concalls, you had mentioned that the new orders for the FY23 contribution would be around in the range of 350 odd crores. So are we on track, or the headwinds which global auto industry has been facing for past some time will deviate our goal?
Agree. So for this, with the new orders, we are noticing we will be booking around 260 to 280 crores for this year.
For the coming fiscal?
For the coming fiscal, this would be at a range of 450 to 500 crores.
Okay. So you are expecting a very big growth in the overall top line for next fiscal, right? Or there would be some major phase out from this current year?
Yeah, talking about the current business, we are noticing the IC segment, particularly the two-wheelers, might get a hit with the acceptance of customers to the EV. So we are noticing that, and also with the other factors like increasing fuel prices and cost of production. So with that, we are expecting the current sales with existing customers and parts might come down. But the good thing is we have added these parts, and this will help me to cushion up and further increase sales going forward.
So would you be able to quantify a bit the phasing out products or the contribution of?
That we will come back, but the phasing out will be less, only that because due to the challenging market. So we are not anticipating that there will be a growth in the running business. So that is the challenge factor that we are now factoring in our plans.
Got it, sir. One last question, if I may squeeze in, just a short one. How is the revival seen in two-wheelers? Do you get some feelers from the OEMs?
At this moment, we don't see really the enthusiasm from these OEMs. And we are keeping close watch and connect with our existing OEMs to get a feel on this. So that is the situation at this moment because of the dynamics of the market.
Oh, okay. Thank you. Thanks a lot, and wish you all the best. Thank you.
Thank you. The next question is from the line of Raghunandan NL from MK Global. Please go ahead.
Congratulations, sir, for good results under challenging circumstances. And many thanks for the detailed opening remarks. Sir, my first question was, being an early mover, company is gaining market share in the EV space across segments. Would you be targeting higher market share in EVs compared to that of ICEs? And can you talk a bit about company strengths or competitive advantage which will support you in getting the market share on the EV space, both in domestic and export markets?
So, thank you. This is Rajiv Sikand. Our playbook here is very simple. We are developing thermal technology, and this is very, very unique. And this has been done because of our European plant. The know-how was developed from 2016. And we've been supplying to Bosch, who supply to all the OEMs, then to JLR, to Samsung. So this technology is our playbook. And so we have divided our parts, thermal and other. So our focus is thermal. Yes, at the same time, we have to focus on other parts in the EV segment. But we are finding that our capability is really being looked at all the global, tier ones, or like Ghana is a tier one. So, but they build a system for the bus. So this is where we are coming in. I hope that answers your question.
Yes. Thank you, Rajiv sir. So basically, just extending on the same question, in terms of competition, would you say that this work which you have done on the thermal side has put you ahead of the competition, and that will continue to remain a competitive edge for us?
See, when you come as a first mover, because of our advantage, because of Alicon, where we invested and we took this up in 2016. So this will remain for a time being. I don't see this competition going. But sooner or later, people do copy, do acquire. So, but it is going to give us 1 or 2 years of headwind, of free space to take this on, because it's not so easy. You may even get the technology, but how to manufacture, how to handle on the shop floor. So we have paid that price in our building up in Alicon, and that kind of thought process is now available with us.
Thank you, Rajiv sir. That is very helpful. My second question was on the order book side. Management did make a statement, 260 to 280 crore order for FY22 and 450 to 500 crore order in FY23. The clarification I wanted is it the amount of new order executions, or is it the new order bookings which was referred to?
These are executions. This will be the realization from these accounts, what we have booked in past.
Thank you so much, sir. And another clarification was on TACO. The order book which we have is that lifetime order book of 150 crore or that yearly order of 40 crore. This is the overall order book with TACO, or is it the new order wins?
It's actually a new order win. And what is happening, TACO, we are doing two things. One is we are supplying their global facilities, which they have acquired. And secondly, Tata Motors have gone in with the concept where other OEMs are doing born EV. Tata Motors have adjusted their EV. They have taken Nexon and other current car, which is in IC, and made a EV. So they have gone head on in this. So what we have proposed, they are importing these parts from China, these critical parts, and assembling them. So we are going to come in their phase one of localization to develop these very strategic thermal solutions for them. And we have bagged those two orders as of now in the two very critical models.
Understood, sir. Thank you. Thank you for that. Next, I had a question in terms of the underlying domestic industry. Is there any improvement which you are seeing in the production schedules for the underlying two-wheeler segment for February or March, now that the COVID wave intensity is waning?
As my colleagues have said, we are seeing this demand is muted. And you are much aware that how much OEMs have put up their capacity and what are their numbers. So the reading is it's a couple of issues which they are facing, and as my colleagues have already highlighted, both on the demand side and the supply side. And the consumer is facing in the entry level motorcycles, their own value in terms of purchasing power. And then there is also, let us not run away that there is a demand destruction to extent with all this COVID on and off. A lot of service industry has got impacted. small restaurants, small businesses like that. So there is an impact which we are seeing.
Understood, sir. Thank you. To Vimal, sir. Sir, on the input cost inflation pass-through, now that the focus is on the monthly adjustments, given the further pass-throughs that are happening, would Q4 see a better gross margin compared to the Q3 levels?
Yes, definitely, because in the last quarter, when I explained that there was the impact of the cost inflation on the margins. So, and we have started negotiations with the OEM, and we have seen the impact in the quarter 3, and that is still not settled with all OEMs, and that is also in process. So definitely we are seeing that the further improvement in the margins in quarter 4.
And sir, on Europe operations, can you help us understand the key factors helping profitability? The management highlighted that now that the EV businesses are ramping up and initial phase the margins are on the higher side, would that be the main reason, or would there be any tooling revenue which is also helping the margin?
See, it is all composite. It's not only one, it's tooling revenues, it's operations getting streamlined on those parts. If you make the same part every day, all the other costs which were there in terms of building those parts, plus, of course, the margin. So our team in Europe has done very good. We have a general manager from India, one of our best guys are running there, Mr. Satyapal. So we are very happy to see the progress our European team has done.
Thank you, Rajiv, sir. Sir, my last question on the side of your technology partner. So just wanted to understand from you how the support is continuing given the COVID times and travel is restricted. I mean, how is the support continuing on new product development, plant upgradation, or they helping in terms of, Enkei Corporation helping in terms of getting new orders?
Yeah, good question. Sorry, we have also missed out that. See, Enkei is our teacher. And just to give you, before I answer that question, I give you an answer as we have a new project with Toyota. And with the COVID times, these people are not able to come from Japan. But every day they are able to visit the shop floor virtually. They are able to discuss this development. So every day there is a call at 2:30 in our Indian teams, Toyota India, Toyota Thailand, Toyota Japan is joining. And there is a value addition from both sides, discussion. Same thing is happening with Enkei. That meeting is fixed. One is on a need base, which is typical, and one is on a quarterly base. So both the things continue, and Mr. Suzuki is very, very active personally in getting his updates. Every quarter we have 2 meetings with him, so which is even more than what we were having when he was coming physically. Of course, we were having a virtual meeting, but so this is a way I think the world has evolved. Not only Alicon, every other supplier is also evolved in the same way.
Thank you, Rajiv sir. That was very helpful. I'll come back in the queue for more questions.
Thank you. The next question is from the line of Dixit Doshi from Whitestone Financial Advisors. Please go ahead. Mr. Dixit Doshi from Whitestone Financial Advisors, your line has been unmuted. We would request you to kindly unmute from your end and go ahead with your question.
Yeah, can you hear me?
Yes.
Yeah, thanks for the opportunity. My question is, you mentioned about the EBITDA margin, that this quarter it was around 12%, and as a percentage of sales it will look lesser because of the increase in the alloy prices. Since the denominator has increased. So, at the same time, you also mentioned that margins will be 14 to 15% very soon. So even at this high alloy prices, you expect that margins can come back to 14-15%?
Yes.
Okay. Okay. That's it from my side. Thanks.
Hello.
Thank you. The next question is from the line of Karthikeyan from Suyash Advisors. Please go ahead.
Yeah, good morning to everyone. I had a couple of questions. One is the order book that you spoke about, the 3,250 crore of new orders. This is not adjusted for inflation, I assume. Is that correct?
Yes.
Right. So as and when the actuals come through, that is when the adjustments will be done.
Yes.
Right. The second part is that of the order backlog, you said an incremental 200 crores roughly would be executed next year over the current year's base. Is that correct, sir? I'm just making sure that I understood it correctly.
Right.
Yes.
Right.
Yes.
Right. And the third thing is, what would be the current two-wheeler contribution to your revenues? Because you gave a fairly, shall I say, not so very optimistic commentary on the two-wheeler segment. So can I know the current contribution of two-wheelers to your revenues, 9-month basis?
Currently, it's 50%.
I'm sorry, sir, I missed that number.
It's 50% currently.
Currently 50%, yes. Last question would be this, so you spoke about Illichmann revenues being limited to a certain level and a lot of the production being transferred to India. So in that context, I'm asking you this question. So when a customer places an order, does he identify the location or does he identify the entity? How exactly does that work? So can you split the order backlog between Illichmann's orders separately and parent entity separately? Any thoughts on that would be helpful?
Yeah. Basically, what Vimal was trying to explain, that Alicon is our European entity having European cost center. Yes. And certain parts cannot be delivered from India, keeping, sometimes when you start in the EV, there are low volumes or there are special requirements. So Alicon plays that role of easing some business out and acquiring this new parts into its portfolio, which is the playbook. But basically for us, that is the second point is, it's our technology center to bring all these new two segments, EV and the structural agnostic parts or technology agnostic parts, knowledge, their capability to us in India. So that is the role Alicon plays. And it is not that there is some part which is shifted from there. We offer those parts only from India. That is why the customer comes to us.
Okay. Okay. I was just making sure I understood that correctly. Thanks and best wishes.
Thank you. The next question is from the line of Avik Mitra from Avexa Financial Advisory. Please go ahead.
Hi. Thanks for taking the question. More than a question, I think I need your view on the long-term path of the company. So the first question is basically on you have presently 70% domestic revenue, and I think mostly it is coming from your legacy business. And as you have already said that the legacy business part, mainly the two-wheeler part, will have some kind of a headwind ahead. So how would you plan to execute your this long-term projection of reaching 2,000 crore revenue by the next 3-4 years? So if you can give your view, I think I'll appreciate that more. This is another question.
Thank you. This we will divide into two parts. Over the last 3 years, we have been reducing our two-wheeler share of business. So it's not that suddenly we have, it's more than a 3-year strategy, or 4 years, we have been reducing this, our share. Secondly, what we are going is we are going for higher machining content. So whereas there is a more value add which we are providing, and of course, two-wheeler is by volume. It does not mean it is by the value addition also. So just to give you a context on the whole thing, and now I let Rajiv answer you on your numbers.
Yes, over here, as Mr. Sikand has explained, we are focusing on increasing the share of business. Also, we are trying to penetrate to the existing accounts where we were not there. Like earlier, we were supplying a cylinder head. Now we added a pipe or we added a headlamp where we were not there, which will increase my content per vehicle. And also, we are now focusing to add new logos where we are not there. So with this mix, definitely we are going to increase our sales in this particular segment.
Okay, and but your EBITDA margin actually is almost the same or plus minus a few percentage points over a quite some time now. If I look into the trend, so if you can give a comment on what is your roadmap on this basically going ahead.
So first is that when you see the EBITDA margins, so there is a structural change in the business that is explained by Mr. Sikand and Rajiv Gupta, that are reducing our exposure in the two-wheeler market, but moving towards the other segments, either CV or passenger vehicles, where we are having the complete machine parts, so increasing our value addition. So there are we can see the improvement in the EBITDA margins, but that as I explained, there is a major impact has come due to the cost inflation in the last 2 quarters. Otherwise, if you take that impact and remove, so definitely we are on the improvement side. But now we have taken the 2 ways to counter this. One is that to deal with the customers, going to the customers and asking for the absorb this cost and participate in this. And second is we have taken a lot of actions in-house to reduce our cost. So how to improvement in our operations, then like the operational cost we have to reduce, then where we have seen the cost increase in the logistics, so negotiating with the customers, then output from the people. So every area we are focusing. So from both the actions, from customer as well as from in-house. So that will help us to improve further in our margins in the coming years.
So I don't hold you on this, but I just wanted to understand that what is your wish list of EBITDA margin when you reach say 2,000 crore of revenue?
That is really what we say that the forward-looking statements you are asking me to give.
No, I'm not holding you to that. I'm just asking for your wish list actually, what you wish to achieve.
Definitely, maybe 3% at least we are seeing that improvement, further increase, minimum.
Okay, good to hear that. And my last question, if I may allow, that I think you hello?
Sorry, one more dynamic which has happened, where you are all seeing 18-19 was, the first half was where the industry was doing phenomenally well. And then started the ILFS issue and the decline. Whereas fundamentally, structurally, the things were same. So this itself, this was a changing period. And I think not only us, everybody has faced this challenge and is evolving from here. From this 18-19, the base or the first half was the base where we were growing also at 30%. So this is a very something structurally which we have worked at, and it is not something which has happened. It has started from there and where we have come today, and thereafter subsequently we got hit by these. I thought last year Corona was very tough year. Having worked in this industry for more than 30 years directly, but I think this year has been even more enjoyable, let's put it this way. for everybody. All the things coming at the same time, including the EV overhang in the mind of the consumer, plus the fuel prices, plus the other things which is affecting the purchasing power. So it also gives you insight that what the team can perform under these challenging circumstances.
Yeah, absolutely. I think I really appreciate your effort of maintaining at least the bottom line and top line in spite of the perfect storm which has been faced by the industry for the last 2 years. My last question actually is on again a view actually I'm looking for. That you are writing as a key point in your presentation that not relying to a single anchor customer, and we have got many customers with small per customer kind of revenue of 10, 15, 20 crore if I understood correctly. So as you know, over a period of time, this EV market will also get consolidated, and there will be 5, 6, or 10 players who will be ruling the market. Like any other industry, like in internet, we have seen thousands of companies, but ultimately it has boiled down to few. So how are you placed to really scale up with somebody when suppose that guy is actually stabilized and becomes a leader, throwing out others? Like say Arriva, you will say that is a startup, right? In UK, we don't know what will happen to this company 2-3 years down the line.
Let me give you, a lot of EV companies where we are giving, so no, maybe there is a 30 to 40% down, but some more will come. So this should not be forgotten by everybody, because today somebody is saying, I want to be the Tesla in the bus. So Arrival is coming with that kind of, and they sit on, it's run by a Russian billionaire, and he was a minister, and he sits in a lot of oil assets, and this is their foray into this. So there will be companies down, up. We have to secure ourselves. So this is one point. And we have a policy wherein what we want from each customer, the turnover must not go beyond a point. So we have our own norms, and these norms we review very clearly each quarter. And we are, in fact, when we started way back 5 years back, we were on a higher, and each year we keep on bringing this norm down for a per customer, so that our risk is, we are de-risked to an extent. And of course, as we will go globally, which is also what we want to do, our global business, so that is also another way of de-risking ourselves, besides the four-wheeler and the other industry which we have said.
But suppose somebody scales up really fast, will you be able to scale up with them? That is my question.
Yeah, scale up and down is part of the industry. See, it is not, it is a value chain, and the chain is the weakest will break the link. So if he has to scale up, there is also testing costs, there is also testing times, because homologation times, whether it is India or anywhere in the world. So in automotive, it does not mean scale up means it suddenly changes. Even if they will very, very fast, the fastest we saw the scale up was in 18-19, the first half, where everybody went to the peak numbers. So those kind of things you are able to manage.
Okay, sir. Thank you. These are my questions. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter. Thank you very much.
Thank you. On behalf of Alicon Castalloy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.